Today is going to be one of the most important videos in this whole entire series. It is going to be fair value gaps, which is the most important confluence that you could possibly use. It is the most powerful thing that the market can give you. And it is also the core of this whole entire model. This is what you will be taking your exact entries off of. It's just fair value gaps and liquidity. So once you understand fair value gaps, that's when you'll become profitable. But getting right into it, so we are not wasting any of your time, what is a fair value gap? What? Question mark, question mark, question mark. Big bold letters. There we go. And we'll make it red. Okay. So FVG means fair value gap. So whenever you see FVG, that means it is a fair value gap. So it is an imbalance in price delivery. So an example of a fair value gap is it happens when market moves super aggressively in one direction. And it basically leaves insufficient price behind, which is why price usually draws to fair value gaps. It takes 3 candles to form a fair value gap. And we have a perfect example of one right here. So 1, 2, and wrong one. 1, 2, and 3. Third one's going to be right here. So it takes 3 candles. This is candle 1. This is candle 2, the big black one. Whoa. And candle 3 is going to be the last candle. And it takes exactly 3 to make a fair value gap. So a fair value gap is going to be when you have this area of candle 2 open. The important thing to remember is that the wicks will not touch. So you can see candle 1's wick must not touch candle 3's wick. So an example of what a fair value gap would not be, let's see if I can find it. Right here. Okay. So as you can see, price goes down aggressively. That's not a good example. Right here. This would be a bullish fair value gap because it's going to the upside. But if you can see, candle 1's wick is touching candle 3's wick. So there's no gap in the middle, meaning that is not a fair value gap. If we go down to the original example, candle 1's wick is not touching candle 3's wick, meaning this is a valid fair value gap. So a bullish fair value gap is going to be when there's displacement to the upside, right? So this would be one right here. Bullish fair value gap to the upside. See how the wicks of 1 and 3 are not touching? And a bearish fair value gap is showing displacement to the downside. So the way that we are going to use fair value gaps in this model is going to be, this is where price retraces to before running to an external liquidity. So as you can see, right here, take out internal liquidity. External liquidity is going to be way down here, this low, right there. And we show this is a perfect example. Bam, bam, bam. Name it fair value gap. How you're going to mark these out is you're just going to get this little box, put it at the bottom of the wick and the top of the other wick. And that's how you're going to mark it out, the fair value gap. So, as you can see, price takes out liquidity internally, displaces to the downside, showing the market wants to go down, but it can't go all the way down to external liquidity because it has to manipulate internally first. So as you can see, it retraces and goes back into the bearish fair value gap and then goes all the way down to the external liquidity. So that is it, pretty much simplified. And these fair value gaps happen on every single time frame. So if we go on the 1 minute time frame, as you can see, bullish fair value gap, a bunch of bearish fair value gaps. On the second part of fair value gaps, we will go into how to know which fair value gap actually to trade. But you can see bearish fair value gap, bullish fair value gap, okay? Higher time frame, 15-minute is what we were just on. If we go in the daily time frame, it's fair value gaps on the daily time frame too, right? We'll get into what it means when there's no candle or space in between. But as you can see, bullish fair value gap right there. What's this right here? Bearish fair value gap to the downside because the number 1 wick is not touching number 3's wick, meaning it's a fair value gap showing displacement to the downside. Right? Right. So now that we have basically the base concept of liquidity, that is it for part 1 of fair value gaps. Okay. Part 2, we are going to go way more in depth on how do you know which fair value gaps are important, which ones to ignore, which ones are the highest probability to take the trade off of, and what they mean on different time frames.